please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi there, good morning and welcome. This is Power Breakfast on CNBC TV18. I'm Mangla Malu, and with me to kickstart this new week of trading is Ekta Batra. Good morning, Ekta. You know, we ended Friday at record highs. Wall Street went ahead and did even better, ended the best year since 2006, the start of the year. And now the SGX Nifty indicates it's an all-start in the green.
Well, morning Manglam. Yes, we have a lot of positive cues to work with in today's trading session. Not to mention, yes, the global markets are definitely on our side. And we have earnings which are really kicking off this week with emphasis at the end of the week. So we have a lot to look forward to in terms of important cues. But as of now,
before we start the show, let's take a look at the Asian markets. Remember, most of the Asian markets are shut as we speak, but we are seeing some greens in the markets which are open, which is the Korean markets as well as the Straits, which is up about 0.3%. Korean markets, of course, tomorrow is the big day where North Korea and South Korea will talk for the first time in 2 trading sessions. We got positive cues from Wall Street on Friday, near 0.8% gain seen across all American indices. And now the SGX Nifty at the outset indicates that we are likely to start with a gain of 50 points. That against a gain that we saw on Friday's trading session of another 54 points. So a record high as far as the opening is concerned.
okay, well, let's tell you about what took place on Wall Street. US markets ended at record levels on Friday. It was the best start to the new year for Wall Street in the last 12 years. All 3 major indices have notched record levels and posted strong weekly gains, shrugging off weaker than expected jobs data. CNBC's Dan Murphy gets us a wrap of everything that took place on Wall Street.
The Dow and the Nasdaq have seen their best start to a year since 2006. Dow crossing 25k, remember. And the next major catalyst for these hot markets is going to be Q4 earnings, kicking off with JP Morgan, BlackRock and Wells Fargo later on in the week. But remember, investors may have to make their way through the noise, given the potential charges, write-downs and other special items relating to the new tax reform bill. FactSet analysts still expect all 11 sectors to post earnings and revenue growth in Q4, with energy, materials and technology leading the charge. So the question is, will the upcoming earnings support a down move towards 26k and beyond, or are these markets starting to look vulnerable for a correction? Well, that remains to be seen. Either way, we saw US equity markets surging on Friday, with the Dow adding about 220 points and the other major indices also hitting all-time highs. The Nasdaq climbed almost 1% as Alphabet and Amazon shares hit records. So investors have no qualms about buying hot growth stocks over value stocks right now, which is very, very interesting. And the equity market momentum also comes despite that weak jobs data that we saw on Friday. The US economy adding just 148,000 jobs in the month of December. On the surface, it was actually a disappointing miss on expectations of 190,000. The participation rate also moved sideways, but it wasn't all bad news. Average hourly earnings rose 0.3% and the jobless rate is still at its lowest level since the year 2000 at 4.1%. So the data is unlikely to derail the Fed normalization plans, at least for now.
All right, so record highs for the Wall Street, but we got some data there. The US economy added 148,000 jobs in December. This versus an estimate of 190,000 jobs to be added. So that was a little lower than the expectations, but December and January, remember, are months where we see some sort of uncertainty. The unemployment rate, though, held steady at 4.1%. CNBC's Hampton Pearson reports on the same.
148,000. December non-farm payrolls increased by just 148,000 jobs. The unemployment rate is 4.1%. Average hourly earnings up 0.3%, 2.5% over the last 12 months. Of course, that 148,000 is below the consensus forecast for 180,000 jobs. The net revisions for October and November, a net revision of 9,000 fewer jobs created over the last 2 months than previously reported. December private sector jobs up 146,000. Particular sector gains, healthcare up 31,000, construction construction, plus 30,000. Manufacturing added 25,000 new workers as well. The same for food services and drinking places. The real story here, job losses in the retail sector. The retail sector lost 20,000 jobs in the month of December and is down 67,000 for the last 12 months. The labor force participation rate, 62.7%, basically unchanged for the last 3 months. The U6, the so-called real unemployment rate, 8.1%. Even with this headline number of just 148,000 jobs, the average for the last 3 months is 204,000 jobs per month. One other interesting demographic story in this particular report, the unemployment rate for African Americans has dropped to 6.8%. That's down more than a full percentage point year over year. That 6.8% is the lowest since the BLS started keeping records back in 1972.
Okay, so that's what took place in the US market. But speaking on the jobs data, US President Donald Trump says the December jobs data was good and he expects it to only get better going forward.
The tax cuts are really kicking in far beyond what anyone thought. Numerous companies have today come out and announced that they're going to make big payments to their employees, something that nobody really had in mind. So we're very honored by it, but the market is good. The jobs reports were very good, and we think they're going to get really good over the next couple of months. So again, we're going to Camp David with a lot of the great Republican senators, and we're making America great again.
Okay, well, Steve Leesman caught up with Loretta Mester, the Cleveland Fed president, to get her view on the jobs report for the month of December. So let's listen in.
Now, I view that as a pretty strong report. Remember, it's only about 70,000, 120,000 in steady state, so that's above trend job growth. String of good job numbers over the last year, 166,000 per month. I look at that as very good numbers.
Is it too strong? Are you worried that we're sort of past the full employment level here?
So I think we're basically at maximum employment from the point of view of what monetary policy do, but that doesn't mean it triggers a necessary action. I think what we're trying to do with our monetary policy is calibrate it to where the economy is relative to our two goals, which is maximum employment and price stability, which we are measuring by the PCE inflation rate. As you know, right, we're not at our 2% goal yet on PCE inflation, and what we're trying to do is keep policy so that the expansion remains sustainable and going forward. So we're always doing a balancing act. We're letting the data inform us about where the economy is and where we are relative to our goals, and we're going to set policy appropriately.
I don't think it's a crazy hypothetical to ask you how you would respond to that question if we were printing a 3.5% unemployment rate. Is that something that would be create more anxiety for inflation and necessity to raise rates more than expected? So
certainly, you know, my long-term unemployment rate, right now I'm having it at like 4 3/4. I brought it down over time. And as the economy evolves, you know, those kind of measurements typically change because we're always trying to calibrate. I would be concerned if we tended to get an overheating economy, maybe as indicated by a very low unemployment rate, and therefore maybe that would mean that we'd have to raise rates at a faster pace later on. Again, that's the kind of policy that I'd like to avoid by this sort of gradual increase in interest rates.
All right, then let's shift focus to the European markets. Then in Europe too, major indices closed higher on Friday. This as the investors monitored the Eurozone inflation data, which came in at 1.4 as against 1.5 in the previous month. The US non-farm payrolls data as well took the European markets into consideration. Rather, the European markets took that into consideration. The gains came into the financials, put the FTSE 100 to another record high, the Swiss index too at a record high. Eurozone inflation slow to 1.4% in December. So all three frontline indices gaining, even the peripheral indices gaining. If you take a look at the emerging market space, 0.5% gain seen for both the Brazilian as well as the Russian indices, so indicating a bit of a risk on which is underway. But let's shift focus to Germany then. Talks for a Grand German coalition kickoff. German Chancellor Angela Merkel expressed confidence that talks on forming a new Grand Coalition government for Europe's most powerful state would succeed. Representatives of Merkel's CDU party and the CSU and the center-left SPD have gathered at the Social Democrats' headquarters in Berlin for discussions that will lead to the formation of a new government. Remember, Germany has been without a proper government since inconclusive elections in late September, and all three party leaders are now under pressure to agree to a deal.
I think we can succeed. We intend to work very swiftly and intensively, always keeping in mind what the people of Germany expect from their politicians, to solve their problems and create the conditions so that people can really get involved in our country. I am entering these talks optimistically, though it is also clear to me that we have a lot of work to do in the coming days.
Okay, well, North Korea has accepted South Korea's offer for talks. The person-to-person talks will be held on Tuesday. That is tomorrow. The talks are expected to focus on the upcoming Winter Olympics hosted by South Korea and inter-Korean ties. CNBC's Jerry Kang reports on the same.
He's rather quiet about his birthday celebration. Unlike his fathers and grandfathers, it's not a public holiday in North Korea. There's a couple of theories out there, something to do with the status, which is pretty low in North Korean status system of his biological mother. Some say that it's not the right time because he's too young, or some say that people are having a very difficult time with all these sanctions that are imposed left and right on North Korea. But he did find a very special way to celebrate his birthday week with the talks with South Korea that's set to happen tomorrow. Significant development given that it hasn't happened for a while, and this is a quick turnaround in the mood. But of course, what does he have in mind really after the talks tomorrow, after the Olympic Games next week, is the real question to be asking here. In the meantime, we've been getting a lot of reaction out of Washington, especially, of course, the U.S. President Donald Trump sort of taking credit for this talks happening between the two Koreas. Here is the U.S. President Trump saying that South Korean President Moon Jae-in thanked him.
I'd like to see them getting involved in the Olympics, and maybe things go from there. So I'm behind that 100%. He actually thanked me. He said, and a lot of people have said, a lot of people have written that without my rhetoric and without my tough stance, and it's not just a stance, I mean, this is what has to be done, if it has to be done, that they wouldn't be talking about Olympics, that they wouldn't be talking right now.
All right, then with that we'll shift focus to the currency space. Then in the currency space, the dollar remains on the back foot against a basket of currencies following a weaker than expected US non-farm payrolls report for December.
In the world of commodities, crude oil slightly firm after slipping in the previous trading session on the back of higher US production.
The aftermath of the crash, 32 people missing after an Iranian tanker collided with a Chinese cargo ship in the East China Sea, 160 nautical miles away from Shanghai. Footage shot by the South Korean Coast Guard shows oil spilling in the ocean. It was transporting under 1 million barrels of oil from Iran to South Korea worth around $60 million.
Still tuned into Power Breakfast on CNBC TV18. Well, on to the big macro story that came out on Friday evening. The Indian economy is set for a slowdown in FY18. The GVA, or the gross value added, is set to grow at just 6.1%, much below what the street was expecting. The Reserve Bank of India had estimated the GVA at 6.7%. This would then be the slowest rate of growth that we've seen in the last 4 financial years. The GDP is set to grow at 6.5%, slightly higher than the GVA, but even this would then be the slowest rate of growth since FY14, when the UPA government was in its last year of power. Agri and manufacturing were the two main culprits. Agri growth is likely to slow down to just over 2% from nearly 5% growth in FY17.
Manufacturing, that one is also likely to see a sharp drop. It grew at a robust 8% last year, and this financial year it could grow by just 4.6%. But there is a silver lining. Cross-fixed capital formation, which is an indicator of investments by companies for capacity expansion, could actually see a sharp revival. For FY18, the estimate of growth is at 4.5%, which is much higher than 2.4% that we saw in the last financial year. So here is the chief statistician TC Anant on the various assumptions that have gone into computing this data.
Broadly speaking, implicitly there is an assumption in this whole exercise that was stated last year as well, because at this stage for both revenue collections and government expenditure, the only control variable which we have is budget, because these are policy choices of the government to some extent. We are implicitly therefore assuming in this exercise that budgetary targets will be met.
All right, then Lata Venkatesh now joins us to give her take. So Lata, in terms of GDP number, broadly in line with expectations and the estimates, it's disappointment on the GVA front one has to factor in, but more importantly, I mean, this is FY18. What are we going to take away from this?
Well, first of all, the CSO, its usual numbers are lagged numbers. They give you they count the growth the previous year. This is the only number where they estimate. And this particular year, they are at sea because you're extrapolating from the first half to the second half. Usually, when they extrapolate, they use sales tax estimates. If sales tax grew so much in the first half, it would grow so much in the second half. So, many of these numbers are not there. So extrapolation is usually difficult for the CSO. It is not its core job. It is particularly difficult in a year of disruption, a first half that followed demonetization, that was in the throes of GST changes. You can't really extrapolate to the second quarter what happened in the first quarter, even with seasonal adjustments. So not very reliable number. The second key takeaway is that the CSO, as you heard the chief statistician say, assumes that the fiscal deficit will be met. It's quite possible it won't be met. The government will spend a little more, because the number which has actually fallen is this public administration. The CSO has taken it at 9.4%. Last year it was 11.3%. They're assuming only 9.4% because they expect that the government will cut expenses in the fourth quarter to meet fiscal deficit targets. If it doesn't, then it's quite possible that that number will be higher, and therefore the whole GVA number will be higher. A third takeaway for me is that actually the November-December numbers were very good. PMI was 54.7 in December, highest in 5 years. Truck sales were, mind-bogglingly high. So, given all this, it's possible that the GVA, and even according to experts we spoke, is more likely to be higher than what the CSO is estimating, maybe probably 6.3 or 6.4, closer to the GDP number of 6.5. A fourth takeaway, and this is negative for me, export growth is unchanged at 4.5. Last year 4.5, current year 4.5. But look at imports. Last year was, I think, 2% or thereabouts, 2.3. This year imports is 10%. Why? Because the dollar is cheap. That is what everybody will conclude, that the dollar strength is leading to more import substituting domestic usage. Import substitution, not a very good thing. And finally, for me, a very important takeaway is that look at a per capita GDP. It is 1,24,000 or thereabouts. You know what that means? We have joined the $2,000 club in terms of per capita. Feels good.
Okay, thanks Lata for that, but Rajiv Kumar, Vice Chairman of Niti Aayog, doesn't see too many downside risks for the economy. From here on, he expects 7.5% GDP growth in FY19. Let's hear him out.
There are not too many downside risks at the moment, and this economic recovery will therefore catch pace, will become more robust, and we would get to about 7.5% GDP growth in fiscal FY19. Which translates to about 7.1 GVA, as I would have said. I just wanted to add that.
All right.